Stock markets hit new highs this week, with the S&P 500 and the Dow blowing past their previous record peaks, as Nvidia chalked up the biggest ever single-day increase in the value of a listed company when it gained $277 billion on Thursday alone. Well, to take a look at the market, I'm joined now by Victoria Bills of Banríon Capital Management. Victoria, hi. We have to start with Nvidia after these blowout results. At the moment, it's struggling to keep up with the demand for chips, but is this level of valuation sustainable?
Personally, I believe that this level of valuation is absolutely sustainable for NVIDIA. If we're talking about microchip manufacturing and essentially the demand that is coming out of AI right now, NVIDIA is one of the largest games in town in terms of the supply of those chips that are able to do a lot of the high processing needed or video processing needed in order to perform some of those functions in AI. We do have some smaller players that are coming in and I think threatening to take some small portions of market share. But overall, NVIDIA has proven itself to just be a leader when it comes to not only just microchip processing, video game chip processing, but also CPUs as well. And so I think that it's honestly an opportunity for it to continue to go up and up. And especially in Q2, we're expecting to see some new products coming down the line from NVIDIA, which can only continue to grow their value and their market price.
There have been few times in history, though, Victoria, including just before the tech crash in 2000, when as much money was concentrated in as few stocks as it is now. So should investors worry about the dominance of a handful of big tech companies?
The dominance of tech companies, I think it's always been there, whether we're talking about companies such as AT&T. There's always going to be a market leader when it comes to technology and within the industry. It's the job of kind of younger corporations or younger startups to kind of figure out what are the things that NVIDIA is lacking and where they can make their own space in the area. But I think honestly that, again, where we are seeing this growth happening with NVIDIA and then other like tech stocks, AI is the future. Quantum computing is the future of technology. And so companies that are well positioned to either make the underlying pipes or plumbing necessary in order for these functions to work are going to be the top leaders in this space. So I don't necessarily see it as an issue that NVIDIA is kind of one of the big players in town. The question is who is going to take over some of that market share in the areas where NVIDIA is lacking.
Some of the recent rally has also been down to predictions of imminent Fed rate cuts, which are now being reined in. I know you think there's a risk in cutting too soon.
Absolutely. The economy has been running very hot, whether that's CPI and PPI that we got a couple of weeks back. The economy is not ready for a rate cut, if I'm being quite honest. What we're seeing right now in terms of inflation numbers is that essentially people are continuing to purchase, people are continuing to spend at normal levels, and that is continuing to feed into these high inflation numbers that we're seeing. If the Fed were to cut now, that essentially will just cause inflation to go right back out of control. So it's honestly, I jokingly said a little while ago, it's like, I don't know why people ever suspected that the Fed was going to cut in March or even potentially, I think there's potential actually to cut in June, but I don't understand why people were so gung-ho about the Fed cutting when we've seen such a hot economy over the past few months, whether that's from November all the way up until January. There was just absolutely no way that the Fed is going to consider a rate cut at the rates that people are continuing to spend and continuing to buy.
What would you be looking for in the data then before you would say a cut made sense?
I think we need to see CPI and PPI data coming down. That is a definite. We also would need to, unfortunately, if we wanted to see a change or kind of a rate cut, the economy needs to slow down. And slowing down in the economy without essentially going into recessionary territories would mean also potentially optionality of like job loss. But more importantly, we need to curb people's enthusiasm when it comes to spending. But a lot of the data that we're seeing right now with CPI, the vast majority of that is being driven by rents and by people eating out and going out in the United States.
Victoria Bills of Banríon Capital Management, thank you so much